As an intermediate trader, you're likely facing a familiar standoff. On one side, the exhaustion of spending 10 hours a week analyzing charts. On the other, the skeptical allure of generating passive income through copy trading. The internet is full of strategy providers boasting 300% annual returns. But evaluating your options based on those top-line numbers is a trap. Two seemingly identical profit figures at the end of the year can mask completely different journeys, and more importantly, entirely different levels of risk. Over 12 months, two traders end up with exactly $10,000 in profit. But mid-year, the gray trader suffered a terrifying 40% drop, nearly wiping out their account. The green line never dropped more than 5%. The trader on the gray line didn't achieve the same success. They took on excessive risk to reach the exact same destination, meaning their performance is drastically inferior when adjusted for volatility. Choosing between manual execution and copy trading means throwing out gross profit as your main metric. Instead, audit your available time, your psychological resilience, and your personal risk tolerance. True profitability comes down to aligning your market exposure with the reality of your daily schedule and resources. Manual trading is an active, ongoing apprenticeship. If you choose this path, you need a realistic minimum of 10 to 15 hours a week to dedicate to the markets. That time requires conducting fundamental analysis, plotting precise technical charts, and maintaining a meticulous trade journal to study your own execution. The primary advantage of carrying that heavy workload is absolute granular control. You dictate every single variable, right down to the exact pip where you place your stop loss. This radar chart maps the manual profile. You trade passivity for maximum time commitment and maximum control. That total mechanical authority lets you optimize your position sizing for high-conviction setups, especially when trading on zero-pip spread accounts like NX1. But that control comes with immediate psychological exposure. Because you hold the wheel, you face the direct impact of fear, the greed to hold a winner too long, and the urge to revenge trade after a string of losses. You also pay a hidden cost. Every hour spent agonizing over the 5-minute chart is an hour taken away from your career, your family, or other business ventures. Manual trading builds a proprietary, lifelong skill set, one that remains valuable long after the initial learning phase. Copy trading takes the opposite approach. Instead of executing, your account automatically replicates the live trades of a chosen strategy provider in real time. The immediate benefit is massive time leverage. You maintain exposure to the currency markets while focusing entirely on a demanding full-time career. This table shows the exact trade-off. Copy trading replaces the indirect costs of manual trading, like education, charting software, and the value of your time, with direct financial costs. You pay for that convenience through performance fees or slightly wider spreads on copy trades. This approach shifts the labor from technical analysis to managerial oversight. Profitability depends on the ability to rigorously audit other human traders instead of reading charts. Your control over the actual trading is gone. Your risk management is restricted entirely to what happens before a trade is placed, setting platform-level safeguards and deciding how to allocate your capital across different providers. That lack of involvement creates its own psychological danger. You experience the anxiety of trusting strangers with your money and the intense temptation to impulsively swap providers the moment they have a single bad week. Copy trading secures your time freedom, but trades away your active skill development. Your success is entirely dependent on the quality of your due diligence. Whether managing your own charts or vetting a provider, relying on simple win rates to judge a strategy is a fast track to account destruction. A high win rate is statistically meaningless if a strategy takes huge risks. One massive losing trade will easily wipe out the profit from 3 small winning trades. This formula represents the Sharpe ratio, measuring exactly how much gross return you generate per unit of volatility. A variation is the Sortino ratio. It swaps out total volatility to exclusively measure downside risk, showing how much pain a strategy endures for its gains. You use these metrics to hunt for consistency. A steady, reliable 3% monthly gain is mathematically superior to an erratic strategy that loses for months before landing a lucky windfall. Applying these strict ratios filters out reckless strategy providers who use dangerous behavior, like refusing to close losing positions, to mask their risk behind temporary high returns. Long-term survival in the Forex market requires you to actively trade the dream of raw, explosive yield for structural consistency and strict risk adjustment. Now we apply this to your situation. The optimal choice requires a ruthless audit of your personal resources, not a specific trading philosophy. This chart maps the variables dictating success: available screen time on the x-axis and your need for control on the y-axis. With under 5 hours a week and a goal of passive diversification, you belong in the copy focus zone. Spend this time auditing performance metrics, not staring at charts. Conversely, if you have 10 available hours and a demand for mastery, you belong in the manual focus zone. Your mandate is clear: commit to endless execution refinement and the deep emotional discipline required to execute your own analysis. Systemic failure happens when a trader forces themselves into a quadrant ignoring their actual time constraints or psychological needs. But you don't have to make an absolute choice. Sophisticated intermediate traders refuse to operate in just one extreme. They use a hybrid approach, strategically compartmentalizing their capital to capture both passive growth and active skill development. This pie chart illustrates the baseline mechanism. You allocate a large majority, say 70%, of your portfolio to a diversified group of vetted copy providers. That 70% works in the background, generating passive returns, insulating the bulk of your net worth from the inevitable losses of the manual learning curve. The remaining 30% becomes a protected, active stake. You use this segment purely to hunt high-conviction setups and refine execution. This requires strict psychological separation. You must keep the ego of your manual trading totally separated from the cold logic of your passive capital. Operating inside the FXNX ecosystem gives you seamlessly integrated tools for advanced technical charting and deep metric copy evaluation. Stop chasing gross profit, audit your true time capacity today, and architect a market approach built for long-term survival.